One specific asset class within commercial real estate is frequently cited as the most at risk, and that is, of course, office space. So today we're going to dive into the office asset class and figure out if the crash rumors are true, and if so, how bad could it get? Now, many of you are probably thinking, of course, the office market is going to crash because it just makes sense on a logical level. As more and more people work from home, there's just less demand for office space, and that pushes down prices. But that is, of course, just on a logical level. When you look at the data, it actually looks even worse. Since 2019, net absorption, which is a great measurement that looks at the balance between supply and demand in commercial real estate, it has turned starkly negative, with tenants giving up a whopping 140 million square feet. That is a ton of office space that people just don't want anymore. And 25 million of those square feet have been lost in 2023 alone. So there's actually no sign of this slowing down, at least so far. In fact, evidence points to this horror show actually continuing, with another 67 million square feet of new supply, brand new office buildings projected to come online this year alone. And that is the most new office space coming online since 2009. And this is happening in possibly the worst possible year. So obviously demand is down from work from home that we have already talked about. But the other thing going on economically is that unemployment is projected to rise. The Federal Reserve itself is saying that they are going to keep raising interest rates even if unemployment rises, and they are actually forecasting that unemployment is going to rise from about mid threes where we are now up to about 4%, mid fours in the next year or so. And if that means that there are going to be less employees and employers are hiring less, even the companies that need and are using office space may need less of it. So no matter how you look at it, companies are just using less office space right now, and they may be even using less in the future. And when you look at the data, it is basically showing this across the board. Let me just dig into a couple key topics to show you exactly what's going on here. The first thing I want to look at is vacancy. Vacancy is up to a record 13% right now, which surpasses the previous peak that happened in the fallout from the great financial crash in 2010. Now, CoStar, which is a good analytics firm for the commercial real estate space, is forecasting that this goes up to at least 13.5% by this year or even higher. Actually, over the next couple of years, they're looking that it might go up to 16, 17, and getting even close to 18% for vacancy. If you look at this chart, which shows the forecast from CoStar, it's really telling because they aren't projecting a decline in vacancy anytime in their 5-year forecast. And this is really different from other types of real estate. Like when you look at multifamily, they are projecting an increase in vacancy for a few years, but then it starts to come back down when the market normalizes. But not the case for office. CoStar, one of the most reputable, knowledgeable firms out there, is expecting vacancy to go up and to stay up for the foreseeable future. The second data point I want to talk about is subleases. So vacancy is obviously important because it shows how much office space is just sitting idle and completely empty. But subleases are also really important because it shows that some, companies that have leases in place don't actually want those leases and they're trying to get rid of it. What's going on with subleases is that there are currently 216 million square feet available, which is more than double pre-pandemic levels. This is really concentrated in certain markets. Like if you look at San Francisco, this is probably no surprise, but San Francisco alone has 12 million square feet of of subleases available, which represents over 6% of the total office inventory in the market. New York, which is much bigger, has 31 million square feet available, which is a staggering amount, but is actually lower in terms of percentage of inventory. Still a lot, though, at 3.1%. And this increase in sublease activity is actually happening everywhere. It's happening in large markets, small markets, urban, suburban, you name it. This is really pretty close to a national trend that companies are trying to get rid of their office space, and there's just not enough demand. Other companies don't want to take it off their hands. And to me, this tells you that even though vacancy, which we just talked about, is at a record high, it's not even telling the whole story. Even the companies who have leases, which aren't reflected in those vacancy numbers, don't want their leases. So the total number of office space, like the true demand, is actually even lower than what the vacancy number is looking at. Next, let's look at rent. I guess you could call it a bright spot if there are any bright spots in office right now, but rents have actually recovered a little bit since the depths of the pandemic. I don't think that's going to last, and neither does CoStar. And a lot of that is driven by this sublease activity. Because in some markets, when companies go to sublease a property that they already have, they're offering it at huge discounts of like 30 or 40 or even 50%. And that is just putting downward pressure on rents across the board. So CoStar is projecting that rents are going to drop about 2% this year, but then fall 4% and 6% in 2024 and 2025. So it doesn't look like rents are going to do particularly well over the next couple of years, even though they have rebounded a little bit since their lows. The last data point I want to talk about is construction. I did talk about those 67 million square feet of supply coming on, but I do want to just show you this chart because it's pretty staggering. Look at the huge amount of supply that is coming in late 2023. Again, this is at one of the worst possible times for all of this new office inventory to hit the market because there's just not sufficient demand. Luckily, after that, there isn't a huge pipeline. I think builders have been seeing the writing on the wall for a few months or even years now. And so there aren't as many projects planned, and new deliveries of supply should slow down in the coming years, but the market is going to have to deal with a lot of new inventory in the coming years. So what does this all mean? Do I think the office market is going to crash? I mean, put simply, yes, I do. But let's talk about what that actually means. Commercial assets like office space are valued based on cap rate, which is basically a measurement of market sentiment and what investors at right now are willing to pay for a particular type of asset, and on net operating income, which just basically measures how much revenue you generate and your expenses without factoring in financing costs or capital expenditures. When you look at this, you have to think that prices are going to go down because with higher vacancy and lower rents, things we just talked about, net operating income is almost certainly going to drop. With higher interest rates and a lot of risk in the market, cap rates are going to rise. In fact, if you look at this CoStar forecast, you can see that they are expecting cap rates on a national level to rise from about 7.2% to about 8.5%. And when cap rates rise, prices go down. That's just how it works. As an example, if you had a property with an NOI of, say, $100,000, the value would be just under $1.4 million at today's 7.2% cap rate. But if, as CoStar expects, cap rates rise to 8.5%, that property would be worth just $1.18 million, which is roughly a drop of 15% in value. So that's pretty significant on its own, but that's only cap rates. That's half the valuation question. If you combine higher cap rates with potentially lower ROI or NOI, these could get much worse. You know, those two things combined could really create sort of this perfect storm for office space. So the question is, how bad could it get? And I'm going to get there in just one second, but I first want to just caveat that the things I'm talking about right now are on a national level, and there are still certain areas that are going to do okay. Like, for example, if you look at really high quality office assets, they're still doing okay, actually. Buildings constructed during the last decade still have positive absorption rates, meaning there's good demand for these types of assets. You also see demand persisting in certain Sunbelt markets. You see niche areas like life sciences, for example, is doing really well in areas like Boston and San Diego. But on the other hand, other markets, we already talked about New York and San Francisco as the extreme examples of markets that are doing poorly, but this is happening elsewhere. Markets like Austin, which has strong fundamentals in other areas, is really oversupplied. Other places like San Diego are oversupplied. So you really have to, consider my analysis here on a national level, but if you're going to really dig into it, you're going to want to look at a local level. With that said, let's look at how bad it's going to get at a national level. CoStar, which we've been looking at a lot of their data, so let's just look at what they say. They estimate that the price per square foot, which is one way, not always my favorite way to value commercial real estate, will drop about 23%, which in itself is a crash. So I think that is one good indicator of where prices might settle, 23% down. But there's also somewhere else I think we can look as an indication of where things are going, and that is the public market. Certain real estate, commercial real estate, is bought and traded by public companies. They're called REITs, real estate investment trusts. Other stuff like the data I've been showing you is mostly for private real estate, which is basically anything that's owned by an individual investor or a syndication or even a private equity firm, anything that's not traded on the public market. Now, when you look at the public market, the biggest office REIT, it's a company called Alexandria Real Estate Equities, their ticker is ARE, is down more than 30% over the last 12 months. You look at another company called Boston Properties, they're down 53% as of this writing. So I looked into this, and there's an organization called NAREIT, NAREIT. They're an association of REITs. They measure all sorts of stuff going on with publicly traded real estate companies. And they've shown that office properties, if you look across publicly traded companies, office properties were down 21% already in 2023. And if you look back the past 12 months, they are down 41% in total. Public office space, which gets repriced constantly, and that's really important here, is down almost 41%. And this happens ahead of private markets because public markets get retraded all the time. Like investors are buying and trading stocks in these companies all the time. And so investors who have seen the writing on the wall for years or months now have already started selling off or even shorting office REITs. So if you had that idea and you wanted to short some office REITs, it might be too late. But this gives you a sense where sophisticated public market investors think valuation should go, and it's down somewhere about 30 to 40% right now. Now, private valuations like the ones we're talking about here for smaller investors take longer because they only get repriced on a sale. We don't know how much a property has dropped in value until it actually gets sold. But my general thinking is that stuff in the private sector will probably see a similar drop to the public sector, so somewhere around 25 to 30%. Now, of course, there'll be big variation. Like I said, some locations and some markets will do okay, or might see small declines, while other markets like New York and San Francisco could even see bigger drops than 25 or 30%. I think in some of those markets, you could expect 40 or 50% drops potentially. The other thing that's even making this more complicated or difficult is that banks are shying away from the space, which is going to make a recovery and finding a bottom of this market even more difficult, because even if an investor wants to get into the office asset class and help set a bottom for the market, the financing might not be available, and that's going to make it really hard for the market to find a bottom. So what does all of this mean? Well, first, I'd be really careful, obviously, about buying office space right now. I think private sector valuations are way too high and they still need to come down. So if you're thinking about investing in office, I would be very careful about that. Secondly, other asset classes in real estate could be impacted, particularly around central business districts. So this is everything from retail to multifamily, even to single-family homes, may be negatively impacted by some of the same trends like work from home. And I'm not saying that these other asset classes like residential are going to go down necessarily because office prices are dropping. It's because they both are experiencing some of the same trends. Like people are not going to the office, and therefore, the retail establishments around the offices and homes around the offices don't have as high demand as they used to, and that will put downward pressure on those types of prices. So anything that is in a high density office area, I would also be really careful for. The other thing I think you should look out for is that there is going to be risk to the banks who have a lot of exposure to office loans. Like a lot of investors who buy office space are going to be underwater on their loans. That's just my opinion, but I think that's going to happen. And that could spill over to other areas of the lending industry. This is not my area of expertise, capital markets for office space, but I did have a guest on my podcast recently who is an expert on this, and he does think it's gonna, certain banks that are highly specialized in this area are gonna face some serious stress. He didn't expect it to really spread to the broader banking sector. Hopefully, fingers crossed, we'll see what happens. The third thing I think that you should consider is that other areas of commercial real estate I expect will decline too, multifamily, retail, but I don't expect them to come down as much as office space. The fundamentals are better for multifamily. They are better for retail, for industrial than they are for office. So while I do think there is going to be a significant repricing in office and in other areas, the other areas won't be as bad as office. And then lastly, remember, all of this is on a national level that I'm talking about, and most of this should be analyzed regionally if you're actually going to make an investment. Big cities like New York City, San Francisco are getting hit really hard, while some places like in the Sun Belt could continue to grow. All right, that is my analysis of the office market. I would love to hear what you think if you're investing in the office space, or where you think this whole situation is going to go over the next couple of years in the comments below. Thank you so much for watching. I'm Dave Meyer for BiggerPockets, and I'll see you next week.